Hi, I'm Junaid Bray, one of the portfolio managers on the Net Group SA Equity Fund, and we're doing the quarterly report back for the Q1. So just to touch on performance, what performance has been like for the quarter, and obviously over the longer term periods. So if we look at the quarter, the fund performed about 1.8%, slightly behind the benchmark, which was about 2.4%. But look, I'd rather focus on the longer term track record, and you can see over 1 year, the fund has done 6.3% versus the cap swix, which was pretty much flat, so 6% of alpha over 1 year, and 3 years, 3% of alpha, 26% versus 23 for the benchmark, and comfortably alpha over the longer term as well. You can see that about 1.4% of alpha since inception, and the fund touched its 9th birthday, reached its 9th birthday in March. Since we've been managing the fund. A stat that we like to look at, which highlights the consistency of performance of the fund, is the outperformance of the fund over rolling 5-year periods against the peer group and against the benchmark. So against the category, the peer group, the fund has outperformed about 77% of the time over rolling 5-year periods, and 83% of the time it outperforms the benchmark over rolling 5-year periods. We think that's a good stat which highlights the consistency of outperformance of how we manage the fund. The next slide really just shows you graphically how that outperformance looks over time, with the top line being our fund, and the cap swix being the one in the middle, and the peer group being the one at the bottom. If we look at the attribution for the last 3 months, I won't spend too much time on this, it's a very short period. Really just, some of the positions, significant positions that we had, such as Naspers and Prosus, Aspen, and then shares like Udeco and Anheuser-Busch that contributed to performance. And then what detracted from performance were shares like Pick n Pay, which came under significant pressure due to reporting lower profits on the back of load shedding costs, extra diesel costs. 55 million rand a month, that's, it's a significant cost that they need to incur in order to do business. And then some of the platinum shares coming off, and then shares that outperformed significantly that we didn't own or underweight in the funds were Richemont and Bidvest. If I look at the 12-month performance, which I think gives a more fairer reflection, I think some of the positions that we had that really contributed to performance, we were underweight MTN. We felt that as MTN got north of 160 rand, up to 200 rand, it was in overvalued territory, and we reduced our position significantly. And as the shares retreated, we benefited from that. Naspers and Prosus performing really well as regulatory concerns ease, as China ended their zero COVID policy. The share sort of Tencent has sort of rebased itself in terms of cost cutting, and they're now on a trajectory as they're lapping that low base for earnings growth to resume. So the markets repriced that again, which we felt at about the last sort of 6 to 12 months. Tencent and Naspers were significantly undervalued, and we maintained those positions. Other significant positions that we had was Mediclinic, which we felt was substantially undervalued. We also had decent positions in some of the banks, Absa, and then resources like Glencore and Anheuser-Busch. If I look at what detracted from performance, I suppose Foschini was one of the most disappointing performers over the 12 months. We think that, when they reported some of their trading updates, the actual sales numbers were quite resilient. There are a bit of costs that have picked up, but 40% of the business is outside South Africa, and the Australian operations are performing phenomenally well. The sector's derated on the whole due to weaker macro concerns, and that's dragged all of the retailers down. So we've been accumulating more lower down. And then Sasol's been a disappointment as well. We remain very constructive on the oil price, but Sasol has had some operational issues, and the oil price has come off, so it hasn't performed that well. And we've also been adding there as the shares underperformed. And then some of the other positions, which we had positions in that detracted, was Sanlam and the platinum positions, as platinum and PGM prices came off significantly over the last while. If I give a snapshot of how the portfolio is positioned going forward, about just over a quarter of the fund is positioned in the global consumer names, Naspers and Prosus. We still remain very positive on it despite the share rebounding. We think Tencent remains undervalued, trading at about teens multiple if you take out the value of the associates, and then significant discounts on Naspers and Prosus lines. And management is doing a lot to reduce those discounts. There's a lot happening in the background, which we think will materialize over the medium term in terms of reducing the discounts. British American Tobacco, a core holding in the fund. There are lots of concerns about structural volume declines, but we think that with de-gearing, as well as the recovering profitability on the next generation products, the vapor and heat-not-burn products, that actually supports the share in terms of earnings growth going forward, and supported by a fantastic dividend yield of 8%. On the SA Inc. side, on the financial side, banks, we're still comfortable with the banks. We think that interest rates have picked up significantly, so you get that endowment benefit coming through. But we are starting to get a little bit concerned about credit losses. But the banks have significant provisions, I think, still at current levels. Our base case is still that there's enough buffer in the system. They've built enough provisions that they can still come through with this and deliver earnings growth. And then selective positions in insurers like Sanlam and Momentum. On the SA Inc. side, in terms of industrial and retail positions, we prefer, despite the macro environment that's weak, we like companies where there's good management teams, they can gain market share in a tough environment, and with well-run businesses with decent balance sheets. So Fushini, we've been adding as it's underperformed. Pick n Pay, we've added again to some Pick n Pay, and then Motus, a car dealership business that's been very well run, very cash generative. We've still hold positions there, and then the resources, significant exposure to resources. We still think that the demand and supply balance is relatively constrained, and we amongst the diversifieds, we've got positions in Glencore, Anglo American, and then on the oil side, we remain constructive on oil, as the world economy hasn't fully reopened in the sense that all the planes are not in the air. China hasn't fully reopened, so we still think that, and supply is quite constrained due to years of underinvestment. So we remain positioned in Sasol for that. That just gives you a snapshot of how the portfolio is positioned. Just over a quarter in global consumer names, 13% in banks, and then a significant position in resources as we split it across diversifieds, PGMs, and paper and packaging. That gives you a snapshot of the top 10. I won't spend too much time there. I'd rather look to the outlook and how we see things going forward. So I think the way we classify it at the moment is possibly darkest before the dawn. I think, we all know that it's been a very tough environment. We've had incessant load shedding, possibly in the last 6 months, the worst load shedding we've ever seen. And what does that all mean? We know that our markets are cheap. This is a custom index that we make of domestic South African names. So mainly banks, retailers, SA industrials, excluding the offshore names and resources names. So you can see we're trading more than one standard deviation cheap. We know we're cheaper relative to global markets. The bottom line is the SA PE, just about 10. The top lines, that's the S&P, the US markets and the world markets. We know we're cheaper than them. And one could make an argument that we're cheap for a reason. We think that, we have seen significant revisions downwards on GDP growth forecasts. Some forecasts are for flat GDP this year, 0.1%. And in this environment, with load shedding being the major constraint, if we know that we've had the worst load shedding in the last 6 months, so does it get better from here? I think what we're looking at is you've seen a significant amount of new projects being registered with NERSA, and if you can see in 2021 when they've initially lifted the first cap of 1 megawatt, you could see a pickup in projects being registered, but that wasn't a significant change in the cap. When they lifted the cap up to remove the 100 megawatt cap, we saw in 2022 lots of projects being registered, 1.6 gigawatts. And then if you look at just this year, what we've had in the month of March alone, we did almost as much generation of registrations as the whole of 2022. So we're currently sitting year to date at 2.4 gigawatts of projects registered. And as a reminder, each gigawatt is one stage of load shedding. So these projects take anywhere from a few weeks for the smaller projects up to 18 months, 2 years for the larger projects to come online. But we do think that as these projects start coming online, and we think from the end of this year, we'll start to see some of these projects coming online. It mainly comes from, we know the IPPs that have been registered, that will start coming on. But industrial embedded generation projects, I think that is quite significant. So if I look at the chart on the left, if you look at that shows you non-Eskom supply. The total non-Eskom supply, you can see on the left, on the chart on the left, how that picks up from 23, from 13 to 19 and into 25 gigawatts over 23, 24 and 25. And we think that if you take that at 30%, because remember solar doesn't produce at 100%, there's a certain amount of sunshine during the day, so we conservatively take 30% of that number as an incremental number, and we think that incrementally you get 1 to 2 gigawatts coming online from the end of this year for the next 2-3 years, which we think is significant in terms of alleviating the power crisis that we face. And this ignores Eskom. If Eskom gets its act together, we're not banking on that. We're just saying from the private sector what can happen. And the chart on the right really just shows you the reliance on Eskom. And as these projects start coming online, you can see we move from 15% of non-Eskom supply to about a quarter of non-Eskom supply by 2025, which we think gives a lot more stability to the outlook. The other very significant thing that's been happening in the background, private sector corporates, that we're seeing the top 40 companies really getting together and trying to work with government. They've earmarked 3 key work streams and task teams focusing on energy, logistics, and crime and corruption. Adrian Gore's written about this. You Google on News 24. We've personally spoken to the CEOs of Remgro, MTN, and some other corporates where they're all involved in this. We are seeing it already on the energy side, as I showed you on the charts before, significant investment from the private sector. On the logistics side, you are seeing tenders being put out by Transnet for the Durban container terminal. And then crime and corruption as well. That's another area that they're trying to work with government to try to get things under control. And we think that, there's significant positive changes that can come in the next probably 18, 24 months, which we don't think is priced in. If we look at some of the corporates and some of the earnings embedded and in the forecasts, we think that this environment, any incremental positive change could be a key catalyst which is not priced into markets. I'll wrap it up there. So we've got some questions coming through, so I'll tackle the first one. The outlook seems positive. Are we being overly optimistic on our outlook? I think, look, we try to be very conservative in terms of and pragmatic when we look at earnings and normalized earnings. But I think at the same time, one cannot just extrapolate that some of the costs will be continued into perpetuity. So where we feel that sort of situation is priced into a share, and the multiple has derated to the extent that it prices in that the excessive pessimism, that's where we'll take a position. So we do try to be pragmatic. Again, the slides that I showed you earlier does not take into account Eskom getting its act together. We're just saying from the private sector, how much can come online. So difficult to say in terms of how much is actually priced in, but certain shares like Pick n Pay, we think it's been one of the hardest hits when it comes to load shedding. They've actually explicitly mentioned the costs, 55 million rand. So analysts have really just taken almost 600 rand into perpetuity and wiped that out. So look, there are some things that corporates can do. Lots of them are investing into renewables, backup power, which is less costly than running diesel. So as that comes through, and as some of the power alleviation starts easing, we think that if you're taking a quarter or half of those costs away, it's significant. You're taking in 300 million rand possibly in costs out over the next two years. And on a company like Pick n Pay where your margin's quite slim, we think that there's significant uplift that can come from that. So how we position the portfolio given the load shedding impact? So I think it's always a pragmatic approach to diversify. So we've got a decent exposure to global consumer names, which has nothing to do with South Africa. We've got the resource companies on the other side. And then selectively, where we feel, as I mentioned, where we feel that there's excessive pessimism priced in, there we will take positions We feel that on a normalized basis, the market's overestimating the pessimism and earnings impact.